So we we shall begin our briefing this morning, August 8th, on the President's Executive Order on investment alts in retirement plans. I am Knut Rostad, President of the Institute for the Fiduciary Standard, and today we have three speakers who will share their views on the importance of what the executive order is, starting by Phyllis Borsey, who is Assistant Secretary of EPSA from 2009 to 2017, and then followed by Tim McGlynn from the Alt View and Kathleen McBride. And Tim and Kathleen, or Kate, I should say, will introduce themselves as they start speaking. So, as I said, this event is being recorded, and we aim to go as long as we have to through the full hour. And we will start with opening remarks, and then open up for questions afterwards. So, I will start with my opening remarks regarding what we saw happen yesterday. And I start with the simple idea that, by my calculation, we're in the 17th or 18th year of this battle between the industry on one side and fiduciary advisors, fiduciary advocates on the other side, to determine what the standard of conduct should be in different fiduciary settings. And it's in this context of uh, 17 years that I look at what happened yesterday and say that this is a new level of the battle, a new part of the battle that is unprecedented, in that this represents a frontal assault toward attack on the heart of what fiduciary means in the 4.5 page executive order that we haven't seen like this in prior years in terms of what the industry was seeking to do. And it's in that way that I am hoping and will do what we can to provide a reply and response to this that is appropriate for its seriousness. I want to just take a minute to look at a couple parts of the order itself to to explain how I think about it, just sort of generally speaking, and that how it should be viewed. Uh, and I start with the rhetorical way that the the order refers to the department's 2022 guidance, which suggested that um, investments of these sorts should be viewed very, very cautiously. Those are my words; those aren't the exact words, by plan fiduciaries, and that's what the department said in 2022, and then 3 years later, the department rescinded that that guidance. And I think that, to me, stands as a metaphor for how completely and totally anti-regulation this administration is, and in a way that, again, I think sets itself apart. Um, then I think that when the order also speaks about the department coming up with new guidance or rules regarding potential litigation to protect fiduciaries um, who want to recommend these products. I think this gets to the heart of why we have fiduciary, and that how these products differentiate themselves by what they are, in that they are far more illiquid, they are far more opaque, they are far more costly. than the typical products that we see in these accounts. And that's why when I stand back and look at this statement, I'm thinking that it represents a zero understanding of what just on a literally on a one-page cheat sheet, what it means to be an investment fiduciary was not even consulted. It is so absent any understanding whatsoever that in that sense it truly is breathtaking. And then finally, I just want to mention that the response from the Department of Labor yesterday to this, I think, needs to be looked at in a way that reflects the reality of how this administration works. And I think that the response by the department, which I'm sure Phyllis and others will go into in more detail, is on one level an embarrassment to the department because of what it suggests. But the context is we are living in an administration now that has a very simple rule, and that is when the White House tells you to do something, you either do it or you risk losing your job, period. And I think that we have now a 6-month record where we see that as how that has played out. So in this sense, I don't believe for a second that this statement reflects the real understanding of the labor secretary or the assistant secretary. It only reflects the fact that they don't want to lose their job. So on that point, I will stop my remarks and hand over the microphone to Phyllis Borsey.
Thanks, Knut. I'm going to try to focus on the two quick things. A few comments about the tone, although I'm going to try to avoid political comments. God knows I could make a lot of them. And then I mostly want to talk about the substance and the practical implications of what this order might create in terms of regulation. I found I didn't find the tone of the EO to be surprising at all. I find it disturbing and troubling, however, that it misleads the public into thinking that the statute and the 50-year history of the Department of Labor's EBSA's interpretation of fiduciary duty is somehow the government putting its heavy hand in interfering in the marketplace, because nothing could be farther from the truth. That's just basically my comment about the tone. I was disappointed, but not shocked, that the Secretary of Labor adopted that same framework and rhetoric. It does seem disturbing to me that the Secretary of Labor or whoever wrote her remarks does not seem to understand the way that the program that she oversees works. So let's start with that. First of all, there's a reason that these kinds of assets, private equity, and the new various kinds of crypto investments, I am a little puzzled about the inclusion of real estate in this litany of things, because if you look at the statistics, quite a number of pension plans offer real estate. Not a whole lot of them in 401ks offer the opportunity for participants to directly invest in real estate. But anyway, there is a reason these are called hard to value assets. They're complicated. They're not at all the financial structure and the business structure of these transactions are not the slightest bit transparent. They result in high fees. They're illiquid. And to me, the tool that's the most important, that is most importantly missing in enabling fiduciaries to decide whether to include or not to include these types of asset categories in their plans is the lack of consensus around publicly available, non-industry generated performance measures. These investments, if you look at them historically, and I think Tim's going to talk about this in a little bit, if you look at them historically, they're like that old nursery rhyme about the little girl with the curl. When they're good, they can be very, very good. And when they're bad, they're horrid. But from a fiduciary point of view, the ability to assess which ones are going to be the really, really good ones and which ones might have the potential for being the horrid ones is almost impossible because of the lack of transparency and information and various other tools for fiduciaries. So this whole premise that the government should be out of the business of picking winners and losers and the government shouldn't decide flies in the face of the statute. The statute is very simple. It vests the decision-making in plan fiduciaries, not in the government, but plan fiduciaries. The statute creates a structure in which the plan fiduciary is the decision maker in all of these transactions, investment decisions, using a prudent procedure. This decision-making process is guided by two critical principles: the duty of loyalty and the duty of prudence. Now, the duty of loyalty has since September 2nd, 1974, when President Gerald Ford signed into law the Employee Retirement Income Security Act, the duty of loyalty has been marked by a standard of care. The standard of care for fiduciaries in making these decisions on what to include, what not to include, et cetera, is a solely in the interest standard. In other words, in making that decision, the fiduciary has one objective and one objective only, solely in the interest of the participants and beneficiaries in that plan. This is well known as the highest standard of care in the marketplace. It's not the substantially weaker best interest standard that the securities laws and the SEC embodied in Reg BI. And it's not, and I'm going to talk about this in a second, it's not what I see as the creeping reduction in fiduciary standards that is suggested in this executive order. This is probably the most troubled substantive part of the rule of the executive order, and let me just focus on it for a minute. Buried in the section that directs the Department of Labor to prioritize reduction of what the EO calls frivolous litigation is a statement that says that what the department has to do in prioritizing this kind of guidance is to issue guidance for fiduciaries that refers to something called the best, allowing fiduciaries to use their best judgment about whether to include these types of investments in their 401k lineups or in the target date funds, et cetera. What the heck is best judgment? And if you think about the hierarchy, the solely in the interest statutory standard under ERISA, that for 50 years, the Department of Labor has put the blame and the responsibility squarely where the statute puts it, on the fiduciaries to make this decision using the prudent process. If you think about that standard of care, solely in the interest. The fiduciary standard under ERISA has been muddied. The waters have been muddied in the securities area by using a lesser standard or articulating a lesser standard of best interest. But best judgment, I don't even know what that means. And it is totally, in my judgment, unenforceable. Unenforceable because no one will know what it means. It creates, after 50 years, as much as people might hate litigation, they have a 50-year history of what solely in the interest means, what the duty of prudence, what the duty of loyalty mean. So it's ambiguous, which means that the courts are going to have to start over again and interpreting whatever that means. But at the same time that the administration and the Congress are dramatically reducing the personnel and resources available to the Department of Labor, and the biggest hit comes in the enforcement area, the administration is also directing the Labor Department to introduce a series of investments that are virtually impossible given the state of the art right now for fiduciaries to evaluate, at the same time that it makes virtually impossible, certainly much more difficult, for the Department of Labor to enforce the current solely in the interest, prudence, and loyalty duty standards. So it's very much opening the door to potential problems. There's one other thing that I want to flag here in terms of a couple of other things on the practical side. These are products, notwithstanding the industry PR campaign, that people in participants in pension plans are chomping at the bit to invest in these products. I don't honestly see much demand on the part of individuals for these products. And if they want them, they can use them in their IRAs, their private other investments. So that means these products are sold, not bought. What does that mean? It means that this also opens the door for greater and greater potential conflicts of interest. Keep an eye out. The people who begin to sell these products, I have no doubt, are going to, well, of course, since you can't get information about any of this stuff, it's going to be really hard. So we're going to have to rely on you folks in the press to do the digging here for us. I have no doubt that we're going to begin to see products offered in the marketplace in which the brokers, the insurance consultants, the investment consultants, the investment managers are going to be given very high commissions and other fees in order to get them to direct both plan sponsors, particularly small employers, and participants to choose these kinds of investments. And so I think we're going to see a much more vigorous problem with conflicts of interest. And finally, the fact is, you can't go to any conference or be on any meeting call in the investment world, or the world of ERISA, without people talking about financial literacy and the severe lack of financial literacy among a lot of the participants and many of the plan sponsors in this field. At the same time, where everyone recognizes there's a problem with financial literacy, the administration wants to encourage people to choose as part of their investment lineup, if you're a plan sponsor or fiduciary, or a participant in making your investment choices, investment products that are complicated, lack transparency, illiquid, high fees, just at the same moment where everyone recognizes that there's a big problem with financial literacy. So what I see this executive order doing is creating openings for very for potential additional harm to participants. An executive order has no legal standing. So keep your eye on the ball. Watch what the Department of Labor does to implement this EO, because in fact, that's where the legal liability and the legal standard comes into. So, I guess,
Okay.
when you think about who benefits from this, it's obviously the financial institutions that have been lobbying for decades to open up the treasure trove of plan assets in 401k plans. And there may come a time, if the marketplace and the market characteristics of these investments change dramatically, there may come a time where it is prudent for a fiduciary to unquestionably prudent for a fiduciary to include them in the plan lineup. At this point, I'm not sure that that's the case.
Thank you, Phyllis. Thank you very much. Next in the queue is Tim. You're
Right.
on.
Thank you, Knut. Background on me, I started a company, if you could call it that, called the AltView earlier this year, and I'm trying to provide evidence-based, logical, skeptical advice around investing in alternative investments. My background is not in policy or law, but rather in investing. For the last 5 years before I did this, 5 or 6 years, I was working in investment consulting, and prior to that, I worked at the pension fund for U.S. Steel and an asset manager, mostly in equity research. And so I'll start out by making a few comments about David Swensen. David Swensen, who is considered in some ways the godfather of endowment investing, passed away in 2021. He wrote a book called Pioneering Portfolio Management, and as the Yale endowment manager, they relied heavily on alternatives. But it is his advice, however, for most, if not all, not just individuals, but institutions, was to avoid alternatives. He said, low-cost passive strategies suit the overwhelming number of individual and institutional investors without the time, resources, and ability to make high-quality investment decisions. So he said alts were only for a small number of investors with the resources and temperament to pursue the grail of risk-adjusted excess returns. He also said active management strategies, whether in public markets or private, generally fail to meet investor expectations. So that's important, not because of what was said, but who said it. And I think it's a bit ironic that his name is invoked. I see it often in the name of selling these kinds of investments. Like Swensen, I am an alt skeptic. Obviously, he saw the way to find ways for Yale to do it successfully, though I think in some cases even their success is seen to be actually better than it was, and there's ample evidence of that. But nonetheless, when I started to learn about alternatives, I started with private equity. I just assumed naively that people wouldn't be attracted to this asset class unless it provided returns that were notably better than public markets. And I was really surprised to learn, and this was about the end of 2021, that wasn't true. I was looking at actual results, and then I, of course, saw what industry players would do. I was working at a consultant, so we had a role in this too, and I became fascinated not just with the results, but with the propaganda success of the industry. The financial services industry often conspires in a way to overcomplicate things and create offerings that are more complex, because that also makes them more expensive and better for the providers of those services. So there's a great deal of agency conflict. And so I've started this initiative, the AltView, to try to provide specific examples of evidence-based criticism of specific companies and what they say and do, in order to highlight the sort of agency conflict that exists and underscore the responsibility of fiduciary investors to take these biases into account because ultimately they're ultimately responsible. If I, as an individual person, want to invest in private equity and don't care what my results are, you know, I can do that, but it's very different in an ERISA context. Yeah, for many investors, actual investors and alternatives, this applies to private equity, it applies to hedge funds. The results do not justify, historically, have not justified the decision to invest. I've seen this firsthand, and I've also seen that when that happens, when the results don't justify the initial investment, what often happens too often is that the benchmarks get changed, the goalposts get moved, and you end up in a situation where weak performance is justified rather than changes being made, and that's something worth highlighting and something that plan sponsors need to watch out for too. I've seen it. I have seen how the sausage is made. I've seen it, and I've seen these kinds of things happen. And when you try, as I have done in my past experience, to highlight these things, that is kind of an unwelcome act because you're kind of saying, well, we haven't done right by our client. And at the same time, that same client is sometimes still satisfied, even though they ought not be. So it's a tricky thing. One thing I wanted to say also is one thing that the way I'm approaching this issue is I'm approaching it more as though if this decision, if for example, private equity as an example, makes sense to do, and like in the Swensen context, if the fiduciary is convinced that they have this ability to get that special result, then I think they should still do it. I don't approach this like from a perspective that simply because it's too opaque or too expensive or whatever, that it should be dismissed out of hand. But at the same time, because of the actual historical results, in the case of private equity, the supplies, having not been very good compared with what they ought to be, it is not a hard decision for a typical new potential investor in private equity to just say, you know what, we're just going to stick with what we know, tried and true public markets, and we should find that our results are highly satisfactory. Yeah, I think, yeah, the last thing I was going to say is in the context of getting those results and getting attractive results and considering how much, just an aside, I've written recently about the BlackRock. BlackRock rolled out a plan for a target date fund that they expect to start offering next year in collaboration with a couple other fiduciaries, a couple other kind of, I'll call them outsourced fiduciaries, which is another issue we could get into. But if you think about it numerically, they offer a target date fund now that costs 9 basis points, so 0.09% per year for the whole thing. Many plan sponsors offer something even lower than that, but in my writing about it, I was comparing the 9 basis point existing product to what they will basically be offering starting next year, and that costs 38 basis points. That sounds pretty low. It is lower historically than a lot of plan sponsors have paid, but compared with, think about it from BlackRock's perspective, they're getting more than 4x the revenue, and that's just putting 20-ish% of the target date fund into alternative assets. So you can see how things map out for them economically and how that a reasonable fiduciary should want to think, well, how is that incentive, that financial incentive, affecting what they're selling? So that's just, I just wanted to highlight that. As Jack Bogle says, in investing, you get what you don't pay for. And that doesn't mean that you can't find ways for these kinds of investments to work, but plan sponsors should for sure be careful and look at the evidence.
Thank you, Tim.
Sure.
Kate, you're on.
Thank you, Knut. So I'm going to back clean up, and I I've had a long career on Wall Street. I'm not on Wall Street anymore, but I started out on Wall Street at an institutional firm and did the through line of these many decades is that I've always tried to bring more information to investors, whether they were institutional or individual, and that's what we still do now. And I think that I look at this a little bit differently. I'm not a lawyer, but I study a lot of the lawsuits that are brought for plans. I'm at an ERISA 402, a named fiduciary firm. And what we do is take over for the plan sponsor in terms of how the plan is administered so that the plan sponsor can back away and not have to do that. They meet with us, but we do that. We don't do anything else in the plan. All the other service providers do what they do. We're just the umbrella. It's a unique it's in a unique position in the retirement community to do that. Uh, and and one of the things that has struck me, especially about this, is Phyllis touched on, and I think this was so important, the exclusive benefit rule for participants. And so I think about the motivation, to put non-traded, non-public, non-publicly priced hard to get out of anything into a plan. And I wonder, why is it that they want to put this into a plan? I have nothing against, the private asset folks, but I look at private equity and I think, well, most of the time, those folks, they want to keep their profits for themselves. So why do they want to share now? Why is it that they want to share? And I think that they want to share now because they want a bigger pool and they see this 401k pool of assets that is chugging along, one of the biggest pools of assets in the country, maybe in the world. And they see this opportunity for themselves, but this is not being touted in any way for the best interest of 99.99% of participants in plans. The private assets that can't be valued, that cannot be sold immediately like a stock or a mutual fund, those are not things that belong in plans. I had the honor last year of being appointed to the ERISA Advisory Council for a 3-year term. And one of the things that we did at the hearings that we held last year, we had around, 50 hours of hearings, I think. That may not be correct, but many days and hours of hearings. One of the things that was very, very enlightening is that even some of the biggest players in the retirement industry, when we were talking about potentially putting things like private equity and annuities in plans, should it be done? Should it not be done? How would it get done? One thing was that plan sponsors really shied away from this because they are aware. A lot of the plan sponsors are really aware that if they put something like this in a plan, that it will not be good for the plan and they will get sued. These lawsuits are not going to go away. And in fact, after Cunningham versus Cornell, the Supreme Court finding in April, which found that, in a nutshell, anything that a plan sponsor does in a plan is a prohibited transaction. And it can only be undone or met by finding the correct prohibited transaction exemption. They have to go together like a hand and glove. And if you don't do that, then a plan sponsor is going to be in big trouble. They could get sued. And this ruling, this SCOTUS ruling, has really not been, I think, discussed enough. But it really does pertain to potentially putting non-traded assets of any kind into plans, non-publicly traded, non-publicly valued, because those are the kinds of things that plan participants will bring lawsuits over. And I think after Cunningham versus Cornell, it's expected that the number of lawsuits will probably rise. It's also, if a plan sponsor has to, for every prohibited transaction that they do, for anything they do in a plan that they pay a fee for out of plan assets, to find that prohibited transaction exemption, they're just not going to be able to do that. And it is almost as if the plan sponsor needs to have help managing the plan, a kind of help they don't have now, by and large. And so putting non-traded, non-exitable assets into a plan at this point, whether it's an annuity or a private equity or anything else that is a permanent fixture that a plan participant can't get out of overnight, in a trading type of situation that can't be valued. I mean, how do you give a participant a value in their plan if you have private equity in there and you don't have any idea what that is valued at. And all of the other private things are the same. You're not going to be able to see what they're valued. They're opaque. They're valued at whatever the creator says they're valued at, but it's not necessarily something that you can vet. And so, with these kinds of things, it's, I think, going to be, I don't think it's going to be an easy slog in as much as everybody's been talking about this last, little bit of time to get these into a plan. I don't think most plan sponsors will agree to them because they are cautious about being sued. And so my view is, look at the motivation behind this. Private equity, they don't want to share. So why are they sharing now? And it's the same for the other private investments um, that folks are looking to put into plans, and in a lot of ways about annuities as well in plans. So there is a lot of literature out there. There's literature on the DOL website to check out about this, and we're happy to take questions. So thank you very much.
Thank you, Kate. Thank you, Tim. Thank you, Phyllis. Yes. Now we've opened the floor for questions from those listening in, those on the call. So just identify yourself and pose a question, please.
Hi, can you hear me?
Yeah.
Hi, this is my name is Dave Bodemer. I'm a editor with wealthmanagement.com. So we primarily focus on the financial advisor community. But I just had a couple of questions, I guess, about some of the products that have already been developed. Like, well, Tim mentioned the BlackRock already, but I guess State Street Apollo also has something, and then Goldman recently announced like a CIT. So there's already some product development that had been happening. So I guess my question is, if they were already working on this, what does the executive order, what is the point of the executive order if some of the stuff was already in the works? And yeah, I'll just leave that question there. The second question is around, another thing that we've seen a lot of from the asset management side is the development of these, so-called evergreen funds, which I think are partially designed for retail investors and potentially for inclusion in some of these plans, and just like thoughts on that, on those structures, these tender offer funds, interval funds, non-traded REITs, non-traded BDCs, that universe of like any thoughts in general on like those structures and yeah. So those are just two questions. So hopefully that makes sense.
Tim, you want to start?
Yeah, I can take that to start. Others might have more perspective on it, but first you're right that well, first of all, there is no prohibition on alternatives in 401k plans now. Others might know about this, might know more about this. There was a lawsuit involving Intel for allegedly having, I guess it was dismissed or Intel prevailed. They had alts, and they still may, I'm not even sure, in their 401k plan. So I think this executive order is more about making it easier and making fiduciaries fear legal action less than they do now, to make it sort of grease the wheels, if you will, from an industry's perspective. That's one way of saying it. The products you mentioned, so there's the BlackRock product I mentioned that doesn't exist yet, but I think it's intended to be rolled out next year. The other one you mentioned was Goldman, I think a private credit part of, or some kind of component related to that. The State Street Apollo product is not I mean, I suppose it could be put into a 401k, but that exists outside of retirement funds now. So there's a wealth management side of this, and then there's the retirement 401k DC side of it. And then with respect to evergreen funds, I mean, I can make a general comment. I've done a fair amount of research on evergreen funds, which, for those that don't know, evergreen funds are semi-liquid structures, generally allowing investors to invest on a monthly basis. And the investment company generally provides 5% monthly liquidity. So 5% of the capital invested can redeem monthly, but that's at their discretion. They can close the doors and gate the fund if they choose. I see a lot of, I've spent a lot of time specifically working or researching secondary evergreen funds, which are funds that are buying stakes in private equity, existing private equity funds from other limited partners, so from other investors in said funds. And it's rapidly growing, and that's where a lot of retail money is flowing in. And I mean, I don't know, at the risk of spending too much time on it, might be easier to talk about it offline, but because I could spend half an hour trying to describe all the problems. I've written about these on Substack. But yeah, it's probably best to follow it up. But I see it, it's clearly a trend. And these are SEC registered funds, I should say, also. But they're also not in 401k plans. They might well end up in them. Or some form of them might well end up in them. We'll see.
Thank you, Tim. Kate, Phyllis, you want to add anything to that question, those two questions?
Well, I just want to underscore what Tim said, which is there's no prohibition against including these in 401k plans now. The only, but it's up to the fiduciary. And so if the fiduciaries felt like they had enough information to make informed, prudent choices consistent with ERISA's standard of care, they would include them. The fact that they don't says something about the state of the market products, more so than anything else.
Thank you.
One final comment on that too. The structure that you're likely to see, and this is the industry talks about this like it's a positive, and it isn't. It may be, but it's definitely a positive for the industry, is for alternatives to be included in target date funds, like I mentioned.
Right.
And if you think about it, I mean, like I mentioned earlier, like my background was in equity research. So I think about it from a business standpoint. This ability of the investment manager to insert these kinds of investments that generate for said investment manager 4x. That's for the entire fund, right? For the alternative component, it's like 10x the fee. And in a vehicle where money is coming in every 2 weeks, because these are savers, they're making their 401 contributions every 2 weeks. You do not have to go out and get the new customer. It's once you get in there, it's almost like a Trojan horse analogy.
And the customers have no idea what bundle of funds make up the target date funds.
Right.
When I was at the Department of Labor, and we were working to develop our 401k fee disclosure regs, the 408(b)(2) regulations, there was a big issue about whether or not target date funds, plan sponsors that offered target date funds within their plan should be required to disclose what constituted the underlying bundle of funds in the target date fund. Even plan sponsors have no idea what funds are. So you're absolutely right, Tim. Even if I were a participant, the most diligent, financially sophisticated participant, known to humankind, getting the kind of information I would need to be able to determine whether I even was investing in alternative funds would be practically impossible.
Right. Relatedly, the performance when the allocations are small enough to these very expensive, lucrative for the seller products, it will be much less likely, for better or worse, that the performance at the overall TDF level will be notably better or worse from the plan participant's perspective, or even from the plan sponsor's perspective.
Well, that's the other problem. The plan sponsor has no idea what the bundle of products within the target date fund. I mean, that's been my experience. Do you two have different experiences?
I want to thank Phyllis and Tim. I just want to have others have a chance to ask a question before we reach the top of the hour. So
yeah, sure.
Yeah, I'd just like to open
Yeah.
again for other questions.
I've got a question. Hi, this is Griffin Kelly with Advisor Upside. We're a B2B newsletter serving advisors. And I was speaking to a few people who said that because alternative assets tend to have pretty long holding periods that could be up to, 12, 15 years sometimes, that they might actually be a pretty good fit for 401ks. And I was just wondering what your thoughts are on that, what your reaction to that is.
Can I take this one for a moment?
Yep, go ahead, please.
So I think that I'm not sure who you're saying is saying that it's such a great fit for funds for retirement plans. 12 to, retirement plans have very different sets of people in them. So it's not always a good fit for a retirement plan, to have that kind of investment where you're sort of locked up. And for a lot of these investments that are not public, you don't know when you're going to be able to get out. In other words, there are times when private investments just aren't going to open back up. If it's a hedge fund, if it's, these are not traded like stocks, obviously, or mutual funds. And so I I urge caution when contemplating putting something that is going to be in a participant's array of choices because they don't understand what that means. They don't necessarily understand what they're getting into, and to put that in front of them is really unfair to the plan participant. And I don't want to sound like Debbie Downer, but I mean, why do that at this point to the plan participants?
Thank you.
Good point. I'd like to first see if there are any other questions, and then Griffin, we can come back to this if there are no other questions. But does anybody else have another question for the panelist?
Hi, this is Brian Anderson, editor-in-chief at 401k Specialist.
Okay,
I've got
Brian.
a quick question. Knowing what you know right now after this development, what kind of take-up would you expect, perhaps 5 years down the road, in terms of percentages of 401k plan participants that allocate, say, 5% of plan assets to equity investments? Do you think, are we looking at a very small percentage that actually utilize this new capability, or a very small percentage of plan sponsors that are actually going to make it available because they're so concerned over potential litigation?
Good question. Panelists.
My answer is I don't know. But I'm inclined to think that, and I'm also perhaps hopeful for the sake of investors, that the uptake won't be all that huge. I think that it may be from the perspective of the industry. It's not like a Hail Mary pass, but it's like such an enormous potential opportunity that just take ethics or whatever out of it for a moment. Let's just say they're just purely motivated to try to make as much money as they can. They should pursue this because the upside is huge. If it works even only sort of halfway. That's my take. But I don't think it will work tremendously well for them, but we'll see. And that's probably for the better of the investors.
Well, and I would
Thank you.
jump in and say I don't think that the upside is huge for participants. I
Yeah,
think the
right.
upside is huge for sellers.
Yeah.
Yep.
Yeah, and I mean, for what it's worth, again, I've highlighted this mathematically on one of my posts on Substack.
Okay.
And I can tell you
at the
very
alt view.
briefly, in my experience advising plan sponsors, yes, there's a concern about litigation, but the biggest concern is the uncertainty around the way these are structured, the fees, the illiquidity, all of the other characteristics that we've been talking about. Fiduciaries find more troubling. They want, as all businesses do, certainty, and there's very little certainty about these kinds of investments. But as Tim and Kate are right, even the tiniest incursion into this $12 trillion market is going to be lucrative for them.
Thank you, Phyllis. We've got a question from Mark Sheff here. Mark, you want to pose your question?
Yes. Hi. Thanks, Canute. Thanks for sponsoring this this event. I'm sorry, I was sidetracked there and I was off this discussion for a while, and forgive me if this has already been asked. But does anyone see a congressional element to the development of the of this idea that alternatives, private investments are going to be allowed in 401ks, or is it just going to be strictly a DOL rulemaking? Do you see House Financial Services or Senate Banking weighing in any way?
Good question. Kate, Tim, Phyllis?
I think that most of those are already allowed and they're not being taken up. That's my sense of it.
Well, none
Well,
of those,
but
none of those, the nub of the issue, Mark,
mhm,
is the fiduciary responsibility provisions in the statute and ERISA. And the only committee that has jurisdiction over
oh,
that on the Hill would be the Ed and Labor Committee, which doesn't, or Ed and the Workforce, so they keep changing their name to protect the innocent, I guess.
yeah,
Um,
you're right. Okay,
and they're, which is not to say,
yeah,
you know, there's a lot of money at stake. And if I were advising the industry people, I would be using every tool in my arsenal to get not just the finger on the scale, not just the thumb on the scale, but the entire body on the scale to push plan sponsors, fiduciaries into taking this up.
right. And I cover primarily financial services and banking, so I that's my hammer, and
I mean,
everything becomes the nail. But you're right; it would be Ed and Workforce or Senate Health that would have jurisdiction here. But have you heard of anybody on either committee, on either side of the Capitol, expressing interest in legislating on this issue?
I don't know whether Senator Warren's office is thinking about that. I know she's been outward about the discussions that have been going on.
Mhm.
So it's possible there might be something brewing there. I have no inside information though.
Do you think lawmakers should weigh in?
It's really hard to say because uh, there is a political aspect to this, and there is a rush to open the doors for things that might not be um, as welcome in plans under a different administration.
Right.
I would say I think about this now and then. I mean, the argument that private equity are, blood-sucking thieves is not a good fiduciary argument for not investing in private equity. So, and there are plenty of sound economic, logical arguments, evidence-based arguments for not investing, for example, in private equity that have nothing at all to do with any kind of political agenda.
Right.
And, which is,
That's a good point.
I think that, there's a certain kind of person that will listen to certain kind of politicians like maybe Elizabeth Warren and think, oh, well, she's going to say that because of her perspective on things. But purely from an economic standpoint, that's how I'm approaching all of this. Purely from a returns risk, risk-adjusted return standpoint. That's where I'm coming down on being alts negative, if you will.
And yeah, and I think I'm negative in large part because these are such fixtures once they're put into a plan. So you can't, I don't really know how the mechanics would work in a plan if someone wanted to start to take retirement payouts, or how do you get those out of private equity or other kind of non publicly traded? How do you know what it's worth? How do you actually give someone a valuation of what their 401k is worth? And you
Right.
don't necessarily know in the interim between valuations, and how good are those valuations?
Right.
I'm skeptical that way.
Right.
Mhm.
Yeah, you don't want to be a plan sponsor that becomes a investor slash rationalizer, right? That
Yeah.
kind of referred to this kind of dynamic before. You make the decision, you're a plan sponsor. 5 years later, you got a couple $100 million in alts in your TDF, and you start to see that things aren't quite what they ought to be, but you can't quite say it's a disaster. What do? The chances are good, in my experience, that you don't do anything and you just let it go. And it's sort of like a pernicious sort of Chinese water torture situation. There may be disasters too, but these are the things that I think about. Just get it in there. If you're the industry, get it in there, and there's a really good chance that the money is inert and won't move. In the meantime, every 2 weeks, your balance, if you know the assets AUM grows by virtue of inflows.
Mhm. Mhm. Great
And
point.
okay, did you have a final comment, Kate?
I was just thinking that one of the things that uh, oh, I lost that thought. Hang on. Somebody else
So-
talk.
Well-
It'll come
Well, I
back.
can tell you that my one guiding principle throughout my almost 50-year career here in advising people about investments is do not invest in anything you don't understand. And that is in my career in the private sector, advising plan fiduciaries, plan sponsors. That is the same advice I gave them. And the fact that there aren't, if these are such wonderful investments, and so necessary to provide, it's so fascinating. Everything is described as giving participants more investment choice. Well, if you look at the research, having too much choice is a problem. And particularly when you give people choices that they don't understand and can't get information about in order to raise their education understanding level. And that's true of plan sponsors as well as participants. So unless and until the marketplace and the structure of these products change, I don't see a big, rush towards investing in them. But both Kate and Tim are correct. Once they're in the target date funds, and that's, of course, why they chose to focus on getting them in the target date funds. That's the simplest way because they don't have to do any other marketing. It's a one-time marketing. They know people are inert, and it's the way to get it done. If you have to sell this investment as a standalone 401k investment to participants, it costs you a lot more money from a marketing and distribution point of view. So until the marketplace changes, as I said, there's nothing that prohibits people from doing it now, but the lack of transparency and information and the illiquidity and complexity is what makes the plan sponsors, the fiduciaries, not willing to make that leap.
Great final point, Phyllis. I want to thank you and thank Tim and thank Kate for
Thank you.
participating, and thank our friends in the Fourth Estate for joining and asking good questions. And on that, we will call it a briefing. So thank you very much.